Share your money, stabilize your life. Welcome to Kelly Sharing. I'm Kelly, sharing practical and thoughtful insights on money.
In 2008, the global financial crisis erupted. The entire financial system suddenly began to shake. Banks were collapsing one after another. Stock markets were crashing. Credit markets froze. Many financial institutions that had once been considered too stable to fail suddenly collapsed within a few months. In September 2008, one of the oldest investment banks on Wall Street, Lehman Brothers, filed for bankruptcy. After that moment, global financial markets were thrown into panic. Investment banks were falling. Hedge funds were collapsing. The real estate market was crashing. It felt as if the entire Wall Street system has lost its stability overnight. But during this financial storm, there was one type of institutions that seemed surprisingly different. Insurance companies. The vast majority of insurance companies continue operating normally. Customers continue paying premiums. Claims continue to be paid. The system kept running. Many of these companies have existed for over a century, some for 150 years, and some even close to 200 years, which leads to a very interesting question. Why do insurance companies seem to fail so rarely? Banks fail, tech companies fail, investment firms fail, but insurance companies appear to remain remarkably stable, and that stability is not accidental. Behind it lies an entire system that is complex and incredibly powerful, a financial safety system built over centuries. In today's video, we're going to break down a simple but fantastic question. Why do insurance companies almost never go bankrupt? Once you truly understand this system, you realize something important. The stability of the insurance industry is not based on luck. It is based on a risk management structure that has been carefully designed over hundreds of years. The core of how insurance companies make money is not luck, it is probability. Insurance companies rely on a very rigorous and highly mathematical discipline called actuarial science. Actuaries are not trying to predict whether a specific individual will have an accident or pass away. Instead, what they study are probability patterns across large populations. They analyze massive amounts of data, including mortality rate, disease incidence, accident probabilities, and life expectancies across different age groups. These numbers are not guesses. They come from decades, sometimes even more than a century, of statistical records. For example, according to mortality data published by the U.S. Centers for Disease Control and Prevention, the probability that a 30-year-old male will die within the next year is roughly around 0.1%. That sounds extremely small, but when we zoom out and look at much larger population, the picture changes. Imagine that 1 million people purchase similar life insurance policies. Based on statistical probability, the insurance company can estimate it that roughly around 1,000 claims may occur within a year. Of course, the exact number may fluctuate slightly from year to year, but when the sample size becomes large enough, the overall results tend to become very close to predicted probability. This principle is known in probability theory as the law of large numbers. The law of large numbers tells us that as the sample size increases, actual outcomes tend to converge toward the expected probability. In simple terms, a single event may be highly unpredictable, but when you observe thousands or even millions of events together, the overall pattern becomes surprisingly stable. This is also why insurance companies need a large number of customers. The larger the customer base, the more accurate the risk predictions becomes. Using these probability models, actuaries can determine how much premium should be charged for each policy. The goal is to ensure that the premium can cover future claims while still allowing the company to operate sustainably. In reality, large global insurance companies process enormous amounts of data every single day. Their models are constantly updated to reflect new medical research, demographic changes, and even shifts in lifestyle patterns. Actuaries continually refine mortality models, health risk models, catastrophe models, and geographic projections. So insurance companies are not gambling on the future. What they are really doing is managing risk through mathematics. In other words, they turn uncertainty into something that can be calculated and managed. But even with actuarial models, extreme events can still happen in the real world. This is why the insurance industry designed a second layer of protections, reinsurance. But even with actuarial models, the insurance industry still has another very important safety mechanisms. Many people find it surprisingly when they first hear about this. Insurance companies themselves also buy insurance. This mechanism is called reinsurance. In simple terms, when an insurance company underwrites a large amount of risk, it does not keep all of the risk on its own balance sheet. Instead, it transfers parts of that risk to specialized institutions. These institutions are called reinsurance companies. The role of reinsurance company is essentially to provide a second layer of protections for insurance companies. Some of the largest reinsurance companies in the world include Mini Re, Swiss Re, and Hanover Re. These companies manage enormous amounts of risk exposed across the globe. Their core business is to help insurance companies distribute and diversify risk. For example, imagine that an insurance company sells a large number of homeowner insurance policies in a coastal state in the United States. If a major hurricane strikes in a particular year, thousands of homes could be damaged at the same time. The total claim can easily reach tens of millions of dollars. If all of that risk remains within a single insurance company, the company could face severe financial pressures. But in reality, a large portion of that risk has already been transferred to reinsurance companies. Those reinsurers then spread the risk across different regions and different portfolios around the world. As a result, the loss from a large disasters are not concentrated in one single institution. Instead, they are distributed across the global insurance and reinsurance systems. This is why even after large natural disasters, the insurance industry as a whole still remains stable. In other words, the reinsurance system functions like a global risk-sharing network. It ensures that no single insurance company has to bear extreme risk entirely on its own. To better understand the importance of this system, we can look at a real historical example. The importance of reinsurance becomes very clear when we look at major global disasters. On September 11, 2001, the United States experienced one of the most shocking terrorist attacks in modern history. Two hijacked airplanes crashed into the World Trade Center towers in New York. Both towers eventually collapsed. The tragedy caused enormous human loss, but it also created massive economic damage. According to insurance industry estimates, the total insured loss from the 9/11 attack were about $32 million at the time. Adjusted for today's value, that would be roughly around $40 billion. At the time, this was one of the largest insured loss events in history. The claim involved multiple types of insurance, including commercial property insurance, business interruption insurance, aviation insurance, liability insurance, and life insurance. If all this risk has been concentrated in only a few insurance companies, many of them might have gone bankrupt. But in reality, the losses were distributed across global insurance and reinsurance systems. US insurance companies absorbed part of the loss. Large European reinsurance companies absorbed another portion. Together, the global insurance markets share the financial impact of the disaster. Of course, actuarial models and reinsurance alone are still not enough. The insurance industry has also built a very strict regulatory system. In the real world, extreme events can still occur. This is why the insurance industry does not rely solely on probability calculations. It also operates under a very strict regulatory framework. In fact, in many countries, the insurance industry is one of the most highly regulated sectors within the entire financial systems. In the United States, insurance companies are not directly regulated by the federal government. Instead, they are supervised by insurance regulators in each individual state. These regulators are commonly known as state insurance commissioners. Across all 50 states in the US, nearly every state has its own insurance regulatory department. Their primary responsibility is to ensure that insurance companies always have the financial ability to pay future claims. To achieve this, regulators impose very strict financial requirements on insurance companies. One of the most important metrics is called risk-based capital, often referred to as RBC. The logic behind RBC is relatively simple. The more risk an insurance company takes on, the more capital it must hold. If a company sells a large amount of life insurance, health insurance, or catastrophe-related coverage, Regulators require the company to maintain sufficient capital to handle worst-case scenarios. If a company's capital level falls below regulatory standards, regulators can take a range of actions. For example, they may require the company to raise additional capital, restrict the sales of new policies, or in extreme case, even take control of the company's operations. In addition to capital requirements, insurance companies are also required to hold large amounts of long-term reserves. These funds are known as insurance reserves. In simple terms, when customers pay their premiums, a significant amount of that money cannot be freely used. Instead, the funds must be set aside specifically for future claims that may occur decades later. According to the data from the U.S. insurance regulatory systems, the total reserves held by the American insurance industry amount to several trillion dollars. These reserves form a very important financial safety cushion for the entire industry. From a financial structure perspective, insurance companies are actually very conservative financial institutions. Unlike many other financial institutions that rely heavily on leverage, insurance companies must continuously prove that they can fulfill promises that may not come due for decades. So when we step back and look at the entire insurance industry, we start to notice something very interesting. Insurance companies have been able to remain stable for decades, sometimes even for more than a century. And that stability is not because of luck. It's because this entire industry was designed from the beginning as a very rigorous risk management system. From actuarial probability models to strict regulatory systems, from the global reinsurance network to the final protection layer of the state guarantee associations. All of these mechanisms stack on top of each other to form a very stable structure. In other words, the entire insurance industry is built on multi-layer safety system. And that's why even through financial crises, natural disasters, and extreme events like 9/11, the industry as a whole has remained remarkably stable. If we look back at the 2008 financial crisis, many financial institutions collapsed because they relied too heavily on leverage and market settlement. But the insurance industry has been able to remain stable because it doesn't rely on emotion. It doesn't rely on luck either. What it relies on is structure. But what's even more interesting is that this way of thinking doesn't only apply to insurance companies. It also applies to the way we manage our personal finance. Many people manage money by relying on luck. They hope the market goes up. They hope their investments succeed. They hope the future just works out. But a truly stable financial system is never built on luck. It is built on structure. A healthy wealth structure usually includes risk protections, long-term investments, cash flow planning, and tax efficiency. When these elements are designed properly, your personal finance system becomes far more stable and far more sustainable. If you're interested in topics like this, on this channel, I will continue sharing insights about investment thinking, wealth structure, insurance planning, and long-term asset allocation. If this video gave you a new perspective, please give it a like. And let me know in the comments what surprised you the most about the insurance industry. Also, if you would like to learn more about how to build a solid personal financial structures, you can check out my earlier videos. I have already covered topics like asset allocations, common financial mistakes high-income professionals make, and how to manage long-term financial risks. And if you like a more personalized analysis, I also offer one-on-one financial structure consultations. You can find the details in the video descriptions. Subscribe to the channel, and in the next video, we will continue breaking down the key ideas that truly shape long-term wealth.